So real quick, Columbia River, we're a small investment firm, been around 3 years. Prior to that, I was at a larger PE firm in New York for about 15 years. We invest primarily in the picks and shovels of technology. So if it's sexy, SaaS, growth equity, burning cash, we kind of run away from that. We focus on businesses that actually generate cash, have earnings, lower margin. So if you look at our portfolio of companies, we have a business that manufactures fiber optic cables. We have a business that distributes Chromebooks. We have a business that provides IT services for K through 12. So that's sort of where we spend our time. So we're definitely not following the trend of, super SaaS, go into a big billion-dollar company. It's a good business. And sort of our thesis has been, yes, everyone wants software, everyone loves software, but you still need someone to help sell it, implement it, maintain it, run hardware on it. And my wife works at Amazon, and she always reminds me that the most valuable company in the world is actually a hardware business. It's called Apple, but they built software, and they control their ecosystem with their hardware plus the software on top of it. So it's sort of an interesting dynamic. And another one of our investors is a senior guy at Amazon, and they love CapEx-intensive businesses like data centers and warehouses because it makes it very hard for people to compete. So it's sort of an interesting philosophy that they have. So that's sort of where we spend our time. Real quick, this is our team. We're sort of a virtual team. But let's talk about what are private equity firms. So who here has a venture capital or private equity firm in their ownership base? So about half to a third of you guys. So I'll just do a quick rundown of private equity for those that don't know. So apologies if it's sort of basic. There are lots of variations of investment firms. There's buyout funds, there's growth equity funds, there's venture capital funds, there's real estate funds, secondary funds. I can go on. There's dozens and dozens and dozens of funds out there. And what they typically do is they're raising capital from high net worth and family offices and institutions, taking it, and then they're investing it in portfolio companies, like what we do. So we sit at the top, or we're a buyout fund. And what's interesting about it is, when we think about financial reporting, you guys are probably primarily dealing with your management teams and what they're looking for. The PE firms have a lot of constituents to deal with, and it's always interesting. We just did a deal with a company, and I was walking them through all their different constituents. Well, we've got the management team itself, right? What they're looking for, their KPIs, what their burn rate is, or what their cash flow generation is. Then as the PE firm, we then have to report to all these other constituents. Our existing investors. PE firms are always fundraising. They're never-ending fundraising. Just like startups are never fundraising, PE firms are always fundraising. We're talking to potential investors, and the financials you show to an existing versus potential can be different, and we could talk about that for other reasons. You have regulatory agencies like the SEC. You have auditors at the PE level. There's firms like Cambridge Advisors, which they call them fund gatekeepers, consultants. So as a PE firm is trying to raise more money, they're always getting benchmarked by third parties. And what they want, and those third parties want to see every detail at the PE firm level as well as all the way down to the portfolio level. And then they want to see consistency amongst the portfolio in terms of how they see the financials. There's something called placement agents. These are guys that are helping funds raise money, right? So they want to see financials all the way down. You've got investment bankers when you're selling or buying a company. You've got tax IRS. You've got lenders. A lot of buyout firms use debt as part of their financing. And then I put very last, the actual company itself, the management team that needs the financials. And oftentimes and not, the PE firms primarily care about their investors first, which is honestly not the right way to do it, but that's what they do. And so there's a lot of different constituents that they have to deal with financials. And so what they want is consistency and clarity. So I'll take a step back. So when we buy a company, right, we typically buy control stakes. And often we're buying businesses where there's an owner, right, who's run his business for himself for 20 years. And often they may have a controller, they may have an AP person, they may have a bookkeeper. And then we come in and we say we've got equity investors, we've got debt investors, we've got reporting requirements now. We put together this nice fancy corporate calendar, right? And we tell them we need monthlies, right? We need quarterlies. We have compliance reports for the lenders. We'll have to do audits. We'll have to do budgets. There's a whole bunch of stuff. So we try to put this in front of an owner. And usually the look I get in their face is like, what the hell is all this? Like, is this value add? I'm like, of course not. It's not value add, but I have to do it anyway, right? Right? Let's say, right? So often what we see on the private equity side, it's very interesting, is finance and marketing are two of the most underinvested departments of these small businesses, and I don't blame them. Often a lot of businesses they can just look at their cash flow, right? They're like, why do I have to do cash accrual accounting versus cash accounting? Right, and I just look at my bank balance every week. Cash goes up, I'm doing well. Cash goes down, I'm not doing well. Right, and we see that. And we just bought a business that was $100 million revenue, doing $20 million cash flow a year. Literally, the owner just did it, looking at his bank statement every week. Like, didn't really have a full finance function. Cash flow positive, doing great, but that's how he ran his business. And so what we try to explain to them is when you take on institutional capital, and you're taking liquidity out, part of your agreement is you got to help the PE firm now deal with all his constituents, right? So it's usually initially a challenge at first, but we figure it out, we work through it, and in almost every case, we end up either replacing or augmenting that company's financial controls. And it's not that they're not doing a bad job. It's just there's a different need now, and there's a lot of constituents that we kind of have to manage. So we start with this, kind of walk them through, and then so some things that we ask them to consider. At the end of the day, now, what PE firms really want, they want to show up once a month, get their financial statements, the company's going up and to the right, and that's all they really want. When a firm starts digging in deeper, it's because it's not doing well, or we're getting reports late, or it's inaccurate. I was just reviewing financials for a company this morning, and we just found out that in January they moved some COGS around, and we're trying to figure out why it got moved around from the prior January. So when you think about what a PE firm really wants, they don't want to get involved. They just want to get their financial package monthly. They want to get their quarterly covenant statements for the banks, and then they want to get their audit at the end of the year. In reality, that's all they really want. The reason why we put all this emphasis up front is because often they've seen it too many times. If you don't lay out this foundation up front, you end up running into a problem. And twice in my career, I've had to step in as an interim CFO where we couldn't get actual reporting. And I'm sitting next to the CEO, and he's telling me, well, my bank balance is doing really well. But I'm like, well, your marketing costs, that marketing cost that you just put in here, where you spent, call it $100,000 for this booth for the next 12 months, but you put it all in the first month, and I have to walk them through what a cash versus accrual is. And so what we try to walk through is, every company is different. We're different KPIs, right? So that we leave that to each company. We also want to understand the revenue, COGS, gross profit, and SG&A, EBITDA, and I apologize if these are metrics you don't know, or the new common term in our world is adjusted EBITDA, right? And if you don't know what that means, it's just whatever you can get away with the lenders that makes EBITDA higher. I'll just be honest. Right, that's what we try to do. Right? That's really what it is. And then, obviously you want to understand the cash flow and the balance sheet, CapEx, net working capital, and taxes. What's interesting is PE firms, I think you said want lots of data. Sometimes there's a lot of analysis for paralysis aspects in private equity firms. We'll want to see year over year, month over month, year to date, actual versus budget, actual versus reforecast, actual versus second reforecast. It can be mind-numbing. So one of the things that we've tried to do is we have a third-party firm called the RightCo that helps some of our smaller companies manage that. And then we're actually working with BSP and some of our companies to help put in something like Adaptive, right? That will help us do better planning. And we're in the process of that as well. The other big thing aside from monthly reporting is there's, K1s, audits, lender compliance, and co-investor compliance. The K1 thing is super critical for private equity firms. So a lot of private equity firms will invest in a combination of flow-through and C Corp. Do people understand the difference between the two? We no longer invest in flow-through entities. Right? If a company is an LLC or an S Corp, we will always put a blocker corp above it. My old firm, we ended up losing 3 investors because we couldn't get K1s on in time. And the investor was like livid that he had to do estimates and extensions. So, and the reason why a PE firm likes flow-through income, and maybe I'm getting too detailed, is they love taking that tax distribution and applying it to the IRR calculation for when they're fundraising. Now, you can make an argument that's really not kosher, but a lot of PE firms do that, is to juice up their IRRs because they take those tax distributions through a flow-through. Our view is let's not play the IRR game, let's actually build businesses. So we put blocker corps in every one of our entities. And so if there's an operating company, there's a blocker corp, and then we'll have an LLC where all the investors sit. And the point of that is when investors get K1s, like I'm literally doing right now, hey, where's my K1? I can write back, it's going to be 0. It may be late, but it'll be 0. You'll have no K1s. And then the other issue that we ran into is, sometimes if you have a state that's a company selling in multiple states, that's a flow through, you could file in 10, 20, 30 states. And then if you allocate the income right across all those states, like I remember I had to file for Kentucky and Missouri for like $1,000, right? So it gets very mindful. Again, that's in the private equity world. So K1s is like super critical for private equity firms, like getting them on time, being accurate, and and often what happens is the PE firms don't appreciate how hard K1s are to get done properly. They'll shove that all down to the portfolio level. So if you're a CFO or controller and you've been working for a family, privately owned family for a long time, and then you have a PE firm that shows up that took 20 investors in their fund, now you got to generate K1s for 20 investors plus the family across multiple states. It's often sort of a holy shit, what did I get myself into situation, and so that's something that's pretty important. Also in private equity, most deals you'll take on lenders, third-party debt, and they're going to require an audit. I've tried many times to get that to a review or compilation. I haven't succeeded once yet in getting that done. It's always been an audit, and audits are painful. So if you've never, and a lot of these private companies have never had to do a full audit, right? There's a setup fee, it takes time. Often lenders want the audit done 120 days after the year end. We always try to push to get it 270 days so we can get it done cheaper during the summertime, right? We try to play that game. Lenders often push back. So audit's pretty important. So again, when you're taking on capital from private equity, aside from the monthly reporting, you got K1s, audit. Also with lenders, depending on what kind of money you've borrowed as part of the transaction, you've got compliance certificates. I think I've got examples, right? You've got compliance certificates as well as borrowing-based certificates. Well, and again, if you don't know what those are, some lenders will borrow against the assets of the company, and every quarter you've got to show that, hey, you're compliant with that borrowing certificate. It could be based on AR, real estate, inventory. Hey, what's the value of it? All right, are you in compliance? And then often on the right, that's the left side. On the right side, if it's a cash flow lender, they have certain covenants, right? Fixed charge coverage ratio, which basically means what is your fixed expenses over your EBITDA, basically, or your total leverage, which is your total amount of debt divided by your earnings potential or your earnings. Again, if you haven't done those before, those can get pretty tricky. Again, when we do like the leverage test, we try to use adjusted EBITDA, right? We try to get creative with that dynamic. And I was just going through one last week where I told the controller, hey, let's add these 4 adjustments and see if we can get away with it with the lender. So she's like, really? I'm like, yeah, let's just try and see what happens. But
what's your success rate?
Pretty high. I mean, we're not going crazy. It's just like, if we're going to install an ERP implementation, right? There's probably a $100,000 implementation cost and then a monthly $5,000. I'm able to add the $100,000 monthly. That's the $100,000 one time, but not the $5,000 a month, right? So if I hire a recruiter to hire a new head of sales, I can add the recruiting cost as a one-time expense. I mean, you have to be sort of reasonable in your requests. Where lenders and where we even push back is if we see that same expense year over year over year over year, but then you sort of add it all back, then that's where it gets tricky. But if it's truly one time, most lenders are pretty thoughtful. And it's interesting, most lenders, they're so busy, right? So we have 6 companies, we're pretty busy. Like Enterprise is one of our lenders. It's a 8-person team. I think they've got 60 companies that they're managing, right? And that they're getting compliance reports. So they just want it on time, right? And it's in compliance. So they're too busy to like go and dig in the weeds. They just want to get their reports, show to their credit underwriting that they're in good shape, and move on.
So I've also done a little bit of investment banking, and we also religiously add backs in to arrive at an
Investment bankers are on the level of add backs, but yes.
Yes. So, but when you sell a company, right, there was always this
Tension.
We're saying
Yeah.
that, hey, without all this investment, we would have had X in terms of profitability, and the buyer is, of course, pushing back the exact opposite, saying, no, I think a lot of those are probably the cost of doing business, right?
Yeah.
So, and they're, well, do you actually have that same discussion actually when you're looking to actually sell a company?
Yeah, absolutely. Same discussion when we're looking to sell a company, walking through what we think is realistic. And look, having done this for almost 20 years now, like you can have a litmus test of what's going to pass and what's not going to be. Often we'll see in these small businesses, owners try to increase their earnings by saying, "Hey, I don't need to be here anymore. I'm no longer. You can hire somebody." The biggest change we often see is, hey, I'm paying myself, I'm making a number $500,000 as CEO, but you really only need a CEO that's $200,000, right? And that's usually like the biggest change that we argue with people, like, hey, that's not realistic, right? But yeah, we have those discussions for sure. But we can make this Q&A, by the way, as well. I know I'm flying through these slides pretty quickly, but we can always talk about these stuff as well. But these are pretty. The first time when we show this to a controller or a CFO, and if they've never done it before, it can be overwhelming for them. So we usually spend a fair amount of time making sure, hey, have you done compliance reporting? Have you dealt with the banks? Once you do it the first time, it's pretty easy the second time. The only time it gets tricky is if you end up failing a test, and that's when we got to go deal with it separately. But if you've got a growing company, this should be pretty straightforward. Even within this, one of the things that we will share with the company, with the finance department, is we'll share them the credit agreement as well, which is usually a 60 to 100-page document. And there's, we don't ask them to read it, but there's a lot of nuances in there of timing, the sample forms, the definition of debt. One of the things that we work with the companies is we were working with a company the other day. They're pitching on some business up in New York to install new hardware for a school, but the school wanted a surety bond, which is another form of indebtedness. So we had to, it's a form of insurance policy. Lenders will look at that type of insurance as additional debt. So lenders are going to have a restriction of how much more debt you can take on. So stuff like that we'll work through with the finance team of understanding all those dynamics. And to your point, one of the last things that we do is we try to also manage personal expenses. Again, when we're buying a private company that's owned by a family or an owner, they're shoving through a lot of their personal expenses to reduce their tax levy, which makes sense. Now you've got institutional investors. One thing we forgot to do, one of our companies, like about 7 years ago, we forgot to share what we agreed to with the owner, that he could no longer expense X, Y, and Z. CFO didn't find out. We didn't pick up on it. So for 3 years, the owner kept expensing like his personal car or trip to Vegas. So understanding what is required, not required, what can be expensed, not expensed through the company's P&L are important things to discuss with the finance team at the company. But usually we try to come up at the PE firm with the templates, and then we walk through the finance team how to do it. It's not hard. It's just nerve-wracking the first time if you've never done it before. I think this is my last slide, and then we can go to Q&A. The things that we've learned is, we talk about sort of best practices. One is people, like understanding how strong the finance department is. Early in my career, we probably looked at it as an oversight because we're always focused on like the growth drivers of the business. now we want to make sure that we always heavily invest in the finance department out of the gate, whether it's bringing a third-party accounting firm or CFO firm to come in, and we'll sit down with the owner and be like, hey, is the person you have today or the team you have today, can they really do the FP&A and the controller function? And if they can't, that's okay. Let's go either try to train them. If we can't train them, then we'll go bring in an outside party. So we spend a lot of time on that. We also try to be very clear on communications in terms of what and when needs to be reported. At the end of the day, my job is really to help strategically with the company, where to grow. I really don't want to be involved in the finances. Like, I really don't want to be, except when we're dealing with the lender or the investors. So we try to be very clear up front, here's what we need and here's what it needs to look like. And so that's why we have that corporate calendar, which can be overwhelming, but we try to use that. ERP systems, a lot of the companies that we work with often start with QuickBooks, and we typically end up migrating them to typically NetSuite or Great Plains or Intact Info or something, Sage. We're actually going through 2 implementations now where we're going from QuickBooks to NetSuite, and a third one that's on Sage that's looking to move to something else because they can't get the inventory reporting right. What we've learned is one of the companies started an ERP implementation. We put it on hold because they had no one at the company to actually manage it. So we're going to hire a controller or a senior finance person to manage that, and then we'll re-engage on that. So that's something that we spend a lot of time understanding is what kind of accounting systems are you on? And ensuring we have the right people to support that implementation. We talked about, we try to help give people packages of what we think they need to look like. Nothing is set in stone, but we try to give people like, here's what we think the monthly package look like. 3 statements, KPIs, MD&A, and then the last piece is what we talked about is K1s, audits, tax estimates. Those are all critical parts of the reporting process from the company up to the PE firm. I think I got 7 minutes left if this clock is right. You good? All right, yeah. So that's sort of my presentation. So I'm happy to open up to Q&A and happy to tell you horror stories if that's interesting or not.
I'd love to get. Oh, it's great. I'm loud, man. I can always talk. Yeah, I'd love to get more of your insights. I've spent a fair amount of my career as well acquiring small businesses and dealing with a lot of those same pain points. One of the pain points we frequently go through is when we have a seller operator, and the seller operator making the transition to, hey, I'm no longer the owner of this company, but I'm still required to operate it. I'm kind of curious if you can speak to the transition stages that you've experienced from your seat. Mine might be a little more engaged just because we're not PE. We are a company that acquires firms and merges them in. So just kind of curious if you had any thoughts on that you could share.
Yeah. Real quick, because I think it's outside the topic, but sure, yeah. It's funny, when we sit down with these small business owners, and again, we're buying companies between 20 and 100 million revenue, right? That's typically our target. And often they're owned by 100% or by family. And what I've learned is, they say all the right things during our process. Hey, we want to be involved. We want to be engaged. And it's literally, you just have no idea once the check hits their bank account how they're really going to react. Some guys are going to take off and go to the NASCAR race. I don't know, go play golf in Pebble Beach. You just don't know. And I'd say it's been 50-50, like whether they stay engaged or not. So what we started doing now in our transactions is we'll sit down with the owner, and if he wants to be CEO, we say, hey, look, great, we're going to back you to be CEO. We're going to move fast. If at any point you are no longer comfortable being in the seat, come tell me. Like, look me and tell me, and we'll go start a search process or look internally. My only request is do it in the first 6 to 12 months. Right, that's my ask, because we have investors that put money in, we have lenders. I can't have you be in and out, and then 3 years from now you say, hey, I'm no longer involved, because the new guy will come in and say he'll want 5 years to run his business plan. So, so that's been actually pretty thoughtful. So we've had 2 guys already come to us. One guy said, hey man, you guys are doing great, a lot of changes, you're running fast. I'd love to be chairman, right? And that was 3 months into our transaction. We started a search process, hired a new CEO or president, whatever you want to call it. So we have that, and if we can't have that dialogue, we just move on from the deal.
Yeah.
Right? Like we say, no, if he want, I have had deals where the guy says he works from his phone, travels around the world. He's a CEO, never goes to the office. Like, we can't have that. Like, I've been there, done that, and I'm too tired. I'm tired to try to do in that kind of process.
Absolutely.
So-
Excellent. Thank you.
Have you tried earnouts to address?
Yeah, so I hate earnouts. Earnouts are painful. They're disastrous. I'll give you an example. We did an earnout on a deal in 2012, my OPE firm. It was for a 13 and 14 earnout. They're still negotiating the earnout. It's 2023, right? It's been 9 years. So if we do an earnout, we will at max do 3 months, maybe 6 max. Very straightforward, very easy to measure. I have wasted more money on legal, and I love, no offense, investment bankers always pitch us earnouts, and I tell them, hell's no, right? Because it's a way to bridge a valuation gap, right? But the problem is the legal costs take too much time, and we're dealing with an earnout now. It was short. The company blew through Q4, hit the earnout, and Q1 is soft again. So what we don't know is did they pull revenue forward? I can't track it. And so I just sat down with the owner yesterday and said, hey man, like we're gonna have to wait. Like the investors don't want to pay your earnout right now because we're not sure if you pull forward your revenues or not. So as a rule, we've stopped doing earnouts, and more and more PE firms out there are just. I'll do seller notes, right? So we can kind of bridge some of it, but we sort of stopped doing earnouts because it's too complicated. And then the legal documentation takes forever, and then when you have then you've got this sort of like weird mindset of for 3-6 months where the owner doesn't want to invest in the business to keep his earnings up, but the new buyer can't force investments because we're trying to figure out the earnouts. So it just creates a lot of conflicts of interest, these earnouts. That's sort of my view. And I've done plenty of them, and none of them ever worked.
So we actually work for Agriculture Capital. We under their asset management side. So all of our portcos are under one management team that reports to the private equity firm. So it's kind of interesting. But as you alluded earlier, they all had different chart of accounts. They all had different structures. And so we actually implemented Adaptive Workday and used it to standardize chart of accounts, standardize reporting. It was really effective in getting on the same page. And we've our scope is growing in terms of getting more involved in IR too as the FP&A team to help out with that. And a lot of that modeling for performance, it's really effective. So I'd recommend. That's
great. BSP, which invited me today to the conference, they do adaptive, right? They do adaptive planning, and they're doing it for one of our other companies. So we've been very happy with them. So I'm excited. I'm excited BSP invited me, and I'm glad to see that Adapt is working. So if you have more questions that are Adaptive or NetSuite or HubSpot, I guess you'll be hosting the booth somewhere. Yeah. So that's the win. Sorry.
Hey Nathan, very, very insightful. One of the things I want to ask you is like, how can like fractional CFO firms be that gap between, you bringing in a full-time CFO, right? You look at the numbers around that, bringing in the salary, bonus, recruiting, time, ramp, all that, right? Versus like leveraging a fractional CFO business that comes with what I call batteries included. So like, how can is that an opportunity that you see for PEs that
100%.
like for the people, the finance leaders that have been there, done that, grown SaaS businesses, and you're like, it's like the buy versus like in lease, right? You're leasing the fractional CFO kind of business. Do you see that as an opportunity
100%.
for more fractionals to partner with PE firms?
Yeah, so we partner with 2 firms. We have a Rightco, which is a fractional CFO, 60 people based on the West Coast. It's interesting. They predominantly were doing SaaS companies, but they're trying to move away from that to do PE companies because I guess they get paid on time apparently. And they are former CFOs, accountants, where they're in 3 of our companies where they either check the financials, they're actually the interim CFO, they're the interim controller on a part-time basis until we have a fully stood up finance function. And then we use BSP as well on more of the ERP assessment side to figure, hey, if we got to migrate, who do we migrate to? How can we standardize reporting? So we use 2 firms, those 2 firms pretty consistently across our portfolio. So they're call it the fractional CFO, and they have a team in India as well that does all the sort of accounting stuff. And then we've got the ERP implementation, and they're 2 different firms that we use for our portfolio. But yeah, absolutely.
Well, this was great. Thank you so much. We
Awesome.
appreciate it.
If you need me, I'll be around if you have any more questions, if I can be helpful.
Great.
Thanks, everyone.
No, thank you. Fantastic.